On today's episode, we are going to take a quick look at Tattoo Chef. They just reported earnings yesterday and the stock price is down about 13.8% today as I am recording this episode. And may I say, I do have shares in Tattoo Chefs, but even though I try to be as unbiased as I can, and there were a few yellow flags investors should keep in mind of during this earnings. So that's definitely what we're going to take a quick look at in today's episode. If this is your first time here, make sure to hit the subscribe button. I recently just did an episode on SoFi. Definitely go check that out. It was a pretty great episode. I shared all the yellow flags and green flags the company has. Pretty much what we're going to do today. So Tattoo Chef, like I mentioned, right now as I am recording, it's very volatile. Down 14% right now. But one thing I do want to say is Tattoo Chef is definitely one of those growth stocks out there in the market right now. So volatility is something that comes in the game. So even though right now the stock is down big, you can see these are levels it was tested out around May. It was also seen around December, November. So the volatility with this stock is always there. And that's, I want to say, start off, that's one of the yellow flags for this company. If you are not prepared for the overall volatility in the stock market, right, Tattoo Chef is probably not the stock to be. And again, this is just part of the game. But let's just jump right into those earnings. I do want to say, and I want to start off with the red flags, right? I do think it's important to start off with what's really going on right now. And I think it's pretty much the overall guidance this company is giving. And obviously, we're going to talk about more. But this company did, first, let's just start off. Revenue for the full year of 2021, they expect between the ranges of 235 to 242 million. So that's about a 58 to 63% year-over-year growth. That is super strong revenue growth. But why do I consider this some form of red flag or yellow flag? This company has recently done an acquisition with the New Mexico, which they call the New Mexico Foods of New Mexico acquisition. If it wasn't for that acquisition, the base revenue growth would only be up 222 million, which represented about a 49% year-over-year growth. Again, that's still a strong revenue growth. Again, why was that bad? Because if we take a look at their overall outlook from quarter four, so about 2 quarters ago, that was pretty much the revenue they were expecting 2 quarters ago. So sometimes, I mean, it's definitely kind of good that they're matching, but investors like to see an update in or an increase in revenue guidance. So this is the guidance they gave 2 quarters ago about base of 222 million. They're still saying that that base is still around 222 million. So even in 2 quarters, even though it's still strong growth, not much upgraded from there. The true upgradation is coming from the acquisitions that they have done with the New Mexico food. The second thing I do want to say is, and I do think this is probably the biggest red flag, is their adjusted EBITDA guidance. And before I explain this a little bit better, let's take a quick listen to today's sponsor, a great reason why I'm able to provide so much content to you guys for free. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services The Fool offers. Through the Motley Fool Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you'd like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the Stock Advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. So they expect adjusted EBITDA to be negative $14 to $17 million. And they obviously talk, and we're going to see this is due to the overall growth plan that this company has seen. But investors don't like to see that, especially big changes. So now they expect negative 14 to 17 for the full year. If we take a quick look at the end of quarter four, so 2 quarters ago, they were kind of hoping for adjusted EBITDA in the range of 8 to 10 million. So that's a huge gap, almost 20 million, a little bit more, about $25 million difference. So it went from 8 to 10 million dollars positive 2 quarters ago to now being a loss of 14 to 17 million. If we just take a look at last quarter they also went down. They do mention the reason they went down is just the overall expenses due to the acquisition and stuff like that. But last quarter, they expected an adjusted range of 2 million to 4 million. So in quarter one, they kind of downgraded their adjusted EBITDA compared to their end of year guidance. And now again in quarter two, they're even downgrading it again. And this to me, I want to say, is definitely the biggest red flag. It kind of shows two things. One, management doesn't really have an insight of what kind of future expenses are going. It's kind of showing a form of unpreparedness, and investors don't like to see that, right? I think investors would have been more happy if they would have given us better numbers at the beginning. Obviously, so much have changed, and they do mention that this is kind of committed to the aggressive planning of growth in brand through extensive marketing and promotional spending. Obviously, I mean, and the thing, this is, I want to say, a red flag is because they should have expected promotional growth. They should have expected high revenue growing strategies, right? Because this is where this company is at. So again, I do have shares in Tattoo Chef. I have no plans on selling, but I just wanted to start off with the red flags. The company also continues to be impacted by increases in logistics costs, storage fees, legals and accounting fees, and marketplace shortage in packaging products. So obviously real life problems, but a lot of these real life problems need to be kind of planned ahead. Even though they might just come out of the blue, I mean, some form of planning is still needed, especially for that huge gap of adjusted EBITDA margins. So sometimes I want to say, if you're too bullish in the company, you kind of give them a free pass with stuff like this. Yeah, sure, you can give them a free pass, but at the end of the day, I still believe you have to at least put it in the yellow flag as a yellow flag and keep an eye on it. A second thing is you have to keep management more accountable to what they do. So overall, those I want to say are the biggest red and yellow flags for this company. But there's obviously plenty of green flags as well. Like we saw, right? This company right now is expected to be profitable. It's expected to grow its revenues at crazy levels. This most recent quarter, it grew 45.9%. So a strong growth company, still expected to grow strong revenues in the upcoming year. Right now, their gross margins are about 15.7% for the second quarter. This is a nice upbeat from same time last year, which was about 10.8%. So plenty of green flags, the overall growth. The other thing is they are expanding into new markets, right? Just in August 10th, they did mention that they had kind of entered a new supermarket. In July 12th, they entered one of the big players, right? Kroger. They had entered into those stores nationwide. So this is definitely a growth story, 100% a growth story. But at the same time, I believe that now it has become a growth story with a little bit more risk to it. And that is the main reason the stock price is kind of taking that big hit. Another thing I do want to say though is Tattoo Chef at the end of this quarter did end with still about $140 million in cash. So they still have plenty of cash on their balance sheet right now. I wouldn't be surprised. Unfortunately, I don't want to say this and kind of get some hate with it, but I wouldn't be surprised if a company like this does some form of offering in the future or some form of way to kind of increase the cash and cash equivalents at the moment, especially since they're seeing a little bit more cost and a little bit more of an issue on some of like logistics. So they probably would want to build up a bit of cash. Regardless, this is still a growth story in my portfolio. I have no intentions of selling, but I do believe it's going to be a very, very volatile time for some time. And me personally, I don't think I'm gonna add on to this at the moment. I'm happy with my position. Again, every investor has their own thesis, has their own theory, and has their own bullish case for this company. So no matter what I do should not impact what you do. I just pretty much do with my own risk tolerance. So I hope you guys enjoyed this quick episode. Take care, have a good night, and see you next time.